Welcome back, guys. My name is Adam. I have Rusmin with me and Victor.
Hi, everyone.
Thank you for joining us. And today we have a really interesting topic because we're going to rate someone's portfolio.
Yep.
So this person is someone who watches our YouTube channel.
Yep.
All right. And he sent in his portfolio, and he wanted us to rate his portfolio. He has a number of stocks, 25 stocks. And he wanted to go through it and see what was good, bad, and ugly about it. So I'm just going to go through some of the picks that he has over here. And I think one of the highlights that we can share is that this portfolio at cost was $700,000.
Yeah.
So it's quite a big portfolio.
Yes, very big.
It's big. Yeah. So some names here: Hobie Land, Comfort Delgro, Vicom, Hoppa, Wilma, Thai Beverage, Keppel DC, so on and so forth. We're going to flash this on screen so you can have a look. And then you can see how he's been doing. And I think the first thing we can say that with this portfolio is that it's almost entirely red.
Yeah, I kind of feel sad about it because that is a loss of more than $100,000.
Yeah.
I don't know when he bought this stocks.
Okay.
Right, and yeah, so I mean, there's also no dividends being calculated, so maybe the losses could have been a lot slightly smaller.
Okay.
Right, if you take into account this.
All right.
But it also depends on the time, right? So. So maybe some of the stocks may recover in the future and it will come back. So it's just at a temporary moment only.
So maybe I should jump into a bit more detail about this person. So once again, I just want to share, this is for educational purposes. This is not financial advice. This is not investment advice. Please do not take this as that. But I just wanted to share some information about this person as well and his background, so you get more of an idea of who he is and whether a portfolio makes sense to someone's investment goals and risk profile. So what this person has shared is that he's actually looking for dividend. So he invests for dividends, for income. He's a conservative investor. He can maybe take volatility of like plus minus 25%. Mm-hmm. He doesn't need the cash for the next 5 years, so this money can be locked up for a while.
Very important.
Yep. Okay. And he's comfortable investing in Singapore, which is pretty much what the portfolio is all about. But he's looking to invest in the US. And he's in his late 30s. So he's married with a kid.
I think he's working in the construction sector.
Okay.
Yeah.
All right. So that's his career at this point. So here we go. This is his portfolio. Why don't we just jump straight into what you guys think and how you would rate this portfolio?
So I think generally for normal retail investor, especially let's say he works in the construction, you tend to have not enough time. I know because my dad works in the construction, so I know times are limited, right? So I think a 25 stocks portfolio is too much for him. Too many for him, right? So I think you have to reduce it, right? And when I say reduce, it's not reduce for the sake of reducing, but reduce the lousy stocks, right? If the 25 of these stocks are good stocks, then of course no need to reduce lah, right? But there's definitely some that is not really very good. Okay, so I think we're going to start off with clearing the bad egg first. Okay. Yep.
Maybe first thing first is that when we do a portfolio review, it's very important to not just look at like the gain or losses and then you rate them based on this one lost 50% lousy stock. Right. That's what most people would do, right? But what here, when I first did look at this portfolio, I look at the rate, I feel sad, right? But then I quickly look at the company's name. So I focus on the quality of the company, or the fundamentals of the company, and then we will rate them from there. Right?
The good thing is that majority of the company that he chose is quite a good company.
On a quick glance,
but I think the price he paid is a separate thing, right? A good business can be a bad investment if you pay at the wrong price. Right? Okay. So that one I cannot. It's already there. It's already done. So I cannot. So I just rate based on the company. Okay. So based on his profile just now, he said that he wants to be a dividend investor. He don't want to monitor. So that means the stock he invests, right, must be dividend stocks. So I look at some of the stocks over here, right? Some of them I felt is that it's not dividend stocks. Like for instance, like Phuket Sembawang, which he have about 4.62% allocation based on cost. So if you look at Phuket Sembawang, right, it's basically a property developer business, right? So majority is very cyclical, majority of profit. So even though dividend is consistent at 4 cents, but they don't increase and they don't decrease. But then the business is not predictable. So I won't want to own Phuket Sembawang. So the first stock I'm going to clear for him is Phuket Sembawang. Okay. Then Hong Leong Finance, I will clear Hong Leong Finance because I think if you look at Hong Leong Finance, right, I think there's no difference from the bank, right? They also do lending business, but then banks have a much lower cost compared to them. I think if you want to own Hong Leong Finance, rather you own the bank. And if you look at Hong Leong Finance, right, based on their dividend track record, their previous peak was 2007, and they have not recovered since then to the previous peak. This is the first thing. Second is that every crisis or every bad time that happens to the industry, right, they will cut the dividends. They will reduce, the dividends, right? For the Singapore banks, right, other than 0809, I think one of the banks reduced slightly. The rest all maintained. The 2020, right, was forced to cut, right? Other than that, the banks tend to maintain and increase the dividend. So I think if you want to own Hong Leong Finance, I'd rather you own the Singapore bank.
Okay.
Yeah.
Okay.
And I think related to the Bukit Sembawang, he has this holding called Kyong Hong.
Yeah.
Right, which I think bulk of their revenue also come from building and construction. And building and construction industry, I think it's cyclical in nature.
Yeah.
Right, and it's really not suitable for dividend. And on top of that, I think the market cap is it's 28 million.
Yeah. So your those like non cyclical business like your Bukit Sembawang, Kyong Hong, KSH that you have, I will clear.
Yeah.
Okay. Plus your Hong Leong Finance. Why Yang Zijiang Financial is also I think roughly same as the banks also, because they are doing some financial stuff. Rusmi, want to say the thing?
Yeah, I'm nothing much to say actually for Yang Zijiang, but the way I look at it, it's also in the loan business, like debt asset business. I didn't dive deep into the company, and we don't have time anyway to discuss it. But I would rather, if I'm a dividend investor, I would rather look at something that is a lot safer, like Singapore banks, right? And even though they are semi-cyclical, but that over time the loans value will grow, right? And the interest rate now we are at a very good time, right?
Okay.
So that will make more sense, and you take less risk. Yeah.
So the Got holding is called OTS Holding. So that is I think a catalyst stock. I think they IPO in 2021. The first year they pay dividend, subsequent they don't pay dividend. So it's not a dividend stock, and they are making losses. So I think you should clear that also.
And it's only a 28 million market cap type of company. It's too small. So if you're a dividend investor, I will at least ask you to look out for companies at least 500 or 1 million. Right. So usually mid-sized, bigger companies tends to be a lot more stable than a smaller companies.
So if you look at this company, they sell all those canned food and all this, but it's also quite competitive in terms of that.
Meat,
the final company that we will cut is actually Straight Trading.
Okay.
Right. So I think the majority of their business, even though they used to own ARA, but I think they sold away the business already. And I think they now own ESR, if I'm correct. Okay, which is in Hong Kong. They do, I think, they
still do have their real estate business, but there are better businesses out there, right? So I mean, later we come to it.
So I think these are the 7 companies that we will cut from the portfolio. So from 25 stocks, you will cut to left with 18 stocks. Right?
Okay.
With the extra cash that come out from all this, right, you can plow back into the existing companies, that can increase its yield of the whole portfolio.
Yeah, I still have one more, which is I think Yo Hap Sing.
Oh, Yo Hap Sing, correct.
So they seems to be badly managed. I'm not sure why. I've not been following this company, but I look at the profitability of the company. It's been like loss making or either making a very thin profit, inconsistent. But they do pay dividends. It's just that if you calculate their dividend payout ratio, it is really not sustainable. So I would not invest in this stock really for dividends. And the share price has been like really crashing down, and it's like a lot lower than what we saw in 2008.
Okay.
Right? I don't know why it's so badly managed, but they do offer scrip dividend, which I think when they pay out the dividend, those who don't take out the scrip dividend, it will still be sustainable. It's just that I see that the shareholding for Yo Hap Sing, I think a majority shareholder is actually Far East organization, and they control close to 77%. Right, and with the share price coming down, there is really a risk where they might one day decided to take this private, right? So I wouldn't invest in this.
Right? So you're left with 17 stocks.
So all these are the 8 companies that you would just basically cut off from the portfolio and recycle the capital. And you cut them off because they're either not dividend stocks or they're just not so good. And there are better options out there.
Yes, correct.
Okay. Hey, Adam here. Just wanted to jump in. If you're enjoying this video, I just wanted to let you know, if you want to learn how to invest and pick growth stocks that are able to compound 3 times, 5 times over the next X number of years and include them in your portfolio, and how do you actually value them so you don't buy them overvalued, you want to buy them at the best possible price, do check out alphaquadrant.com. It's open until the end of June, 30th of June, and after that it's going to be closed. So this is a course, an online course that we're going to teach you every single step that we know about how to invest in growth stocks. All right, so we're going to have a live web class, we're going to have online modules and downloads templates and Excel sheets and all of that. So if you're interested in something like this for yourself and you want to learn how to invest for, and review your own portfolio basically and create your own portfolio for growth, do check out Alpha Quadrant. Go to alphaquadrant.com. We're open until the end of June, 30th of June. After that, we're going to be closed for the rest of the year. So we hope to see you on the inside. So with that, let's go back to the video.
Okay, so let's move on to the whatever left behind, right?
Yep.
So if you look at the top, the first one, which is his largest holding based on cost, about 9.19%, that is about Hobbyland, right? So Hobbyland, I think in general, if you look at the dividend, they do pay consistent dividends and sometimes they pay special dividends, okay? But in 2023, this company actually reduced the dividend to 3 cents from 8 cents, right? So I went to look into the 2023 financial reports. A lot of the losses, because they're making losses, that's why they reduce the dividends. This is the first thing. Second is a lot of the losses is based on the fair value losses, right? It's not actual. But if you were to look back into their rental income, right, they're actually still maintaining or slightly improving, right? So actually, right, they are able to pay out 8 cents dividends, but I'm not so sure why did the management decided to drop it to 3 cents. But they do have the reason that they also reduce the debt, right? So they start to reduce the debt also, right? Because of all this macro environment, they're starting to reduce the debt. So you do see the debt actually reduce. But overview, I think in general their rental income is very, very stable, and it's also like majority, one of the big chunk in their profits also. So I think it's still okay to hold this company over a long term.
Okay.
Then next one is actually ComfortDelGro and also Vicom. So that's the second position. ComfortDelGro is about 8.85%. Vicom is about 8.56%. Okay, but I'm not so sure if the person know, because actually ComfortDelGro actually owns Vicom. So when he buys ComfortDelGro and Vicom, actually there's a duplicate, right? So it becomes as a whole, right? So I think in general, ComfortDelGro, if you look at our past video 1 year ago, I said that if we were to remove the taxi business, right, assuming that it's just disappear, right, the yield that you get, let's say based on 4%, that time I calculate, is about 1.08 cents, and the share price did drop to 1.03 cents. I think last year or something like that, right? And it recovers back to about $1.35 right now, 39 cents, sorry. So for ComfortDelGro, I think in general, the bus business, the public transport, the Vicom business is generally still quite strong down there. The taxi business surprisingly is recovering, right, and it's recovering very well. I think I also find myself taking very less Grab also nowadays.
Because you just pissed off at Grab.
I just delete the app. Because
you deleted the app. Wow.
Yes, I mean, because I realize I pay for the subscription. Okay, don't talk about the taxi. I pay for the subscription for the food, right? But my wife who don't have the subscription can get lower price than me on the same thing. So
I've seen some of that on Reddit as well. People are complaining about it.
So then what's the point for me to subscribe? Right? So I'm a bit pissed off, and I see that every time when they overcharge for the thing, and when I go to the Comfort app, it's much cheaper.
So you use the Comfort app now for your
I use the Comfort app now. I literally delete my Grab app.
I always find that Grab pricing is a lot more expensive.
Crazy. I really hope Meituan come to Singapore, and give some competition.
So the taxi business is
it's sort of coming back, and also with the government recently, I think they do a change in policy to reduce the maintenance cost. I think in the past, right, at taxi below 3 years, right, they have to inspect about every 6 months. Okay, so right now they change it to once a year, right, and they also extend their lifespan for those non-electric taxi to 10 years. So generally, it spread out the cost.
We won't be able to do a lot of deep dives on all these individual companies because this will last for hours. So we just do a quick, overview.
So I think Comfort is still okay. It's just that the price he paid is slightly a bit higher. So for Vicom, I think the business in general, I think the big worry is actually the electric car, whether the parts are much less and all this. But I think Rusmin told me that
so now they are actually charging about the same rate for internal combustion car. About the same rate because they say the number of inspection that is needed for electric vehicle is about 115 versus 131 for ICE car. Right, so it's very similar. So they are charging about the same rate. So I think margin wise it's also very similar because the manpower cost is also about more or less the same. So that part, I think in the past we used to get worried about EV, right? But and on top of that, Vicom also have non-inspection business. So I think moving forward, it's less of a concern. This one will still be a dividend stock. It's just that recently they cut down the dividend payout ratio from 90 to 70%.
Yeah.
So that dividend is more stable now, right? After the reduction.
Yeah, because previously it is unsustainable. They pay out from their cash.
More than 100%.
Yeah, more than 100%. So that was a thing that we flagged to our members at the point of time. Okay, but overall, I think most people don't know. A lot of people say Vicom, they do inspection business, but actually their majority of revenue is from the building business, not the car inspection.
So building inspections.
So building inspections will always be there. It's recurring. So that is their main business.
They don't disclose the percentage, but I think we found out that it's actually more than 50%.
Because we went to buy their Accra, you can buy the Accra and go and find out. But that was many years ago. I think 10 years ago we did
would have
it.
changed a bit.
So we know that majority is actually the building inspection business. Then finally the third position, the fourth largest position is actually Hoppa.
So Hoppa, I think they are in the business of Tiger Balm. So I think you guys probably have seen Tiger Balm everywhere. All right, even if you're in the US. So this is a cash cow business actually for We family. And they also have an investment stake in UOB and UOL. So essentially this company is really, I think, as a good dividend stock, right? So he has a good pick on this.
I think the price he paid also not bad.
It's pretty good, yeah.
Pretty good, yeah, for this Hoppa.
Yeah. And then next, of course, is Wilmar. Wilmar is actually an integrated palm oil companies. I mean, they are not just in the upstream, which is very cyclical because it depends on commodity prices, but they also focus on midstream, refinery, and then downstream, which they sell the Jinglongyi, right? Yep. The brand in cooking oil, and they have a huge market share in China itself, right? So not only they are focused on palm oil industry, they are also in the sugar. So they do this integrated business model that allows them to become more resilient. So if the upstream is struggling, the downstream will do well, right? And vice versa, right? And yeah, so they have their logistic arm also. Now they are expanding into like this food providing all this food catering to a lot of company in China. So this business, I think, is the dividend itself is also still sustainable. So it's also a good dividend stock, given that now the yield is actually more than 5%.
Yeah. Just that this company is quite volatile because it moves up and down based on the commodity. Even though it is very integrated, but people still view it as a commodity business.
Yeah, his price is decent. Just as very complicated. If you want to monitor this, it's impossible.
Yeah.
Too many.
So I mean, would you say that if he's someone that doesn't really want to monitor his holdings, then something like Wilmar is a bit too complicated?
I think, when you invest in Wilmar, you're really investing in the management. Kwok, I think it's a very capable chairman. So, and they have this integrated model in a way that they're taking care of each other, right? So you can just sort of like ignore it. But it's just that a lot of people still treat Wilmar as like commodity stock. Yeah.
Okay.
Commodity prices go up, they'll go up. And when commodity prices go down, they'll go down.
Okay.
Yeah, so you just need to bear that in mind, right? So, and next one I think is Thai Beverage.
Yeah, I think in general Thai Beverage is a good business. I mean the beers is ranked number 2, but new competition came in, Carapao, but only take up 1% of the market share. I think the thing about Thai Beverage is that they are being affected by those like high raw material costs, right? So that was previously, but right now I think it subside a bit for their in terms of their beer that's recovering. The raw material and the packaging costs also start to reduce. So one of the raw material costs for their beer is they hedge until first quarter 2025, right? So if the Ukraine war were to continue to maintain, maybe they may have to pay a much higher price for that raw material. Okay. So that is still a question mark. Spirit business is quite stable. They actually dragged down by those associates earnings, which is from the Fraser property, right? Overall, their F&N I think start to stabilize now already also. So in general, I think Thai Beverage is okay. Throughout the past few years, the business have not really dropped a lot. Also, did not have really increased. So if you look in terms of the dividends, right, it's generally quite stable, around 2 cents plus minus, right? Okay. Because they give in Thai baht, so you adjust roughly, it's about quite flattish, I would say. So I think it's still good to hold over long term.
Next, I think is Keppel DC, right? So we talk a lot about Keppel DC, even our past roundtable. So I will not talk too much about it, but their data center REITs and majority of their assets seems quite stable. But now they are currently facing crisis with their Kwantong data center, which the share prices plunge, and I believe that is the reason why he's sitting on the losses. But these are just, I think, it's temporarily.
Yep.
So I think it's still a good REIT to like hold and then collect the dividend, right? So likewise for Mapletree Industrial, facing a lot of interest costs because of the higher interest rate, but the half of their portfolio is actually in the data centers, and the rest are mostly in the industrial assets, right? There are flat factories, business park, right? And yeah, so I think those are quite a decent REIT. And Mapletree Pan Asia, we also talk a lot about it, but they are most exposed in the office side and retail, right? So it's a very good exposure there, right? So they have different subsector of property sector, right? And so generally, I think Mapletree Pan Asia also should do well. It's just that their merger in North Asia has pulled down the performance of Pan Asia, right?
If they have not merged, I don't think the situation will be right now like this.
So those North Asia unit holders will be happy because they are riding on the Mapletree Pan Asia portfolio to help them buffer all those losses. Yeah, so that is for the REITs itself. Any more REITs that I missed out? Parkway Life REITs and Ascenders, which is I think it's also a decent REIT, alright. So I will keep that. Okay, and the same thing for Parkway Life REITs and Mapletree Industrial, right? So he got a very good diversification on the REITs itself. Not too many, but it's diversified across different subsectors. So I will probably keep those. It's just that the price that he entered, not very favorable. I mean, it's not a price that I will go in myself, but it's done. I can't do anything of it, and it also doesn't make sense to sell right now, right? Anyway, he's buying it for dividend, right? So yeah. I will keep that. Right. Those are quite a decent holding.
Yeah. So I think he got another stock here is APAC Realty, right? Which is about 3.2% of the portfolio. I didn't mention just now. I think if I were him, I will clear this APAC Realty also.
Okay.
Right. So why I'm saying that is because, right, if you look at the number of property agents in Singapore, I have the chart over here. So you can see that, right, the property agents move with the property cycle. So right now, based on the latest first Jan one, right, which is 2023 lah. Let's take it as 2023, right, full year, right. We are at the record property agent. So usually the number of property agent increase when there's good times and all this.
Yeah, and there's the HDB recently released its own website. To transact HDBs as well.
Correct.
So there's competition as well.
Yes, correct.
Yeah.
But you can see, so now it's really like boom time. But we all know that properties, it goes in a cycle. Agency business also go in a cycle. They won't die. They will definitely be there. It's just that they go in a cycle. So I think the best time to buy into agency business, right, is when the number of agents is dropping. So you know that the market is not doing well, right? Then you can buy them at a cheaper price. So you can see that from 2013 to 2016 over here, you can see that the during that time the market is really down. The property market is down. That's why the number of agents also reduced. Right. So these are some of the signs that we can look at when we buy into this kind of agency business, looking at the number of property agents.
So this will be like trading the cycle rather than a long-term hold.
Yeah, it's not a long-term holding. Yeah, because they are generally more cyclical. So I won't want to hold this for long term because he don't want to monitor. Right. So this we have to be out. So just now we said 17 stocks, it will reduce to 16 stocks.
Okay.
Maybe a talk about Kim Lee.
Yeah.
Right. So this is the company that used to be under some form of scandal.
Investigation.
Yeah. And CAD investigation, and then they found out that there's actually a related party transaction, which the ex-CEO and the chairman did not disclose. They were fined, and it was a company that I was following, but then when CAD investigation came out, I dropped it because there's a integrity issue here, right?
Yeah.
So, but then after that, now when I look at his portfolio, I went to look at it again. Hey, the ex management has left, and then now the company, they are still a substantial shareholders, right? But when I look at the business, it's a business that I really like actually, right? So they own a bunch of Kim Lee coffee shop. I'm sure that some of us have been there, and they also run this company called Tender Fresh, my favorite. Fried chicken with the yellow rice. And which they brought over actually, right? So I think it seems to be doing quite well financially, right? So but the price that he paid was slightly on the high side, okay? But at this currently, I think it's still quite a decent yield, so I will probably keep it.
Okay.
Yep.
Yeah.
Right. So I think he also have ST Engineering. I think ST Engineering is generally quite stable in terms of defense and all this.
They've
so
got
I think
a lot of government project. Yeah.
So you can still keep that thing. Sets, I think he bought the price quite decent. Okay. Of course, like we say that we have a full video on Sets that we talk. Okay. But of course, the recent result Sets just came out was quite superb for the results. But then, like I say, we still need to make sure that they focus on paying down the debt first.
Yeah.
Right.
Again,
Again, I won't clear his sets position. I will probably hold the sets position.
And the last one, of course, he has like 4.7% allocation on Lion, OCBC, Hang Seng Tech ETF. This one is not a dividend stock, right? So, but I think he's investing it because maybe now the Hong Kong market is crisis. So if he doesn't mind that there's no dividend coming from this, then I'm okay to hold it because Hong Kong is really tech sector is really in crisis.
Okay, but it's recovering already.
Yeah. So, I mean, we do give our opinion on this, but it's really up to him, right? To whether he want to do anything about it. But it's not a recommendation to buy or sell. It's just our take. What if, let's say, I am inherited with this portfolio? What would I do, right? What will we do? Yeah. So, I think Victor at the start already clear out certain position that what he would do if he's being inherited with this portfolio, right? So there's Bukit Sembawang, Switch Trading, you have saying, Yang Zijiang Financial,
APEC
Realty, Keong Hong,
OTS,
KSH, right? So now I think if I have this portfolio, the first thing that I want only for dividend, right? The first thing I want to improve is the yield. Right, because now the yield on cost, as I calculated, is actually only 3.3% based on his cost price for all the holdings that he's getting. So based on 700,000 portfolio, he's getting about 24,000 a year dividend.
Okay,
right,
so
which is
not
too bad.
Actually, not very good, right?
Yeah, but not very good. 3.3% at this current climate, I think you can get easily 5%.
Yeah, because the Singapore savings bond is about 3% at this point.
Yes, I could have just done it there. There's no capital loss. So I would expect at least 1 to 2% spread higher. So that would be a benchmark is 5%, 5.5%. I mean, there's some Hong Kong dividend stock that are giving 8% sustainable, right? But we're not going there because this is a very Singapore portfolio. So what I'll do is, of course, now I talk about KSH. Right, it's a majority of revenue development, not sustainable. You might as well just park it, switch it out, and then go to Mapletree Pan Asia, and that immediately improve the yield from 2.7%, what he's getting from KSH, to 5% above 5%. So that's yield accretive. Okay. You just do this simple rotation, you will do it, right? And OTS not giving any dividend. If you were just to switch up to Keppel DC, which currently giving a yield of like 4%. Right, it's immediately yield accretive. Right. So, and what else? Okay, so you have Keong Hong, right? So I think switch out to Wilma, which is getting above 5%. Right. So I think it's immediately yield accretive. So by just doing this simple switch, immediately his dividend is gone up. Right? Because a lot of these holdings are not paying dividends, or they pay lousy dividend or not sustainable dividend. Right. Yang Zijiang Financial, go to Singapore banks now, on average is giving out 5% yield. Right. Then after that, I see you Hap Sing, poorly managed, owned by 5 years. I mean, it's not very efficient way of running the company. I look at FNN. Hey, they're having sugar war, but they're struggling, and yet they are quite well managed. 5% yield. I just switch out because you Hap Sing now is based on its cost is about 2.5%.
Okay.
Right, doesn't make sense to me. So, and Straits Trading, 4.4%. I think we talk about Clean Capital Land Investment, right? Now that stock is trading at 4.4%, and I think it's better quality. I'll just switch it out because Street Trading still have like a bulk of its smelting business, which is cyclical.
I mean, this is a good point because some people may see, the paper losses and go, I need to hold on to this stock and make it back. But actually, you don't have to do that. Switch it straight away, and you get the yield
accretiveness.
Straight away.
I mean, you should switch to good quality companies. Right? You hold on to lousy companies, 10 years down the road, it's still a lousy company. Right?
Correct.
The share price may go down. So you did not lose money, you lose 10 years of your time.
That's why
you take the 10 years, you change to another company and let it grow from there.
So that's why when you do portfolio review, don't look at losses. Because when you look at losses, it's like, so painful to cut losses. Right? You won't do it. You always hope for it to drop. Go back to my cost price and then I sell. A lot of people have that, but it usually never happen if it's a lousy stock. If it's a good stock, of course you can hold it, right? I mean, it can be temporarily depressed. A couple of DC, he's down like 16%. I'm fine with it, right? Eventually I think it will recover, right? So you should not look at the losses to the portfolio review. Just bear that in mind.
So one question I could ask is that he has picked some pretty decent companies on the whole in his portfolio, right? So why is it that so many of it are in the red at this point in time? The price.
At timing that I think he entered. So the way I look at it, I think
because you also don't know when he bought the company, so
when
how
he
long
has
he hold it.
this amount of money that he save up, then suddenly you realize that it's important to invest. Then what most people will do is that, you have this $500,000, they go to the market, see what stock to buy, and hear stock tips here and there, watch our YouTube channel. Hopefully you pick up the good one. Because a lot of this lousy stock we didn't talk in our channel, right?
Yeah.
And then he started to deploy everything at one go. Right? So that's the common mistake that most people have. When you have like a bunch of cash that you want to deploy, do it slowly. We just did a roundtable on our how do you deploy $100,000, right?
Yeah.
So I didn't deploy everything.
Yeah.
I only deploy like half of it. Right? So or 25% of it actually, right? And the rest is slowly as you move along, you come across opportunity, then you deploy. But if you were to deploy immediately, you might end up with if let's say you're in the bull market and you enter the wrong pricing, a lot of companies that you bought, even if it's a good company, it may drop. Right? So timing is very important. And a lot of people always say that
I think price is very important. The price that you pay for the company. Right? Even though it's a lousy company, but you pay at the right price, sometimes you still can profit out of it.
Correct. So a lot of people always say, maybe when you started learning, right, people always say that time in the market is more important, time in the market. That is largely true if you're in the US.
And if you're only investing index.
And in Singapore, Hong Kong, timing in the market is important. Right? If you got into the stock at the wrong price, because a lot of these stocks the growth are like very slow, right? So they go up and down. Sometimes they trade a PE of let's say 10, sometimes 15. You want to buy at 10 instead of 15, right? Because they're so slow. But in the US, of course, there are a lot of growth company. You want to be invested all the time because you compound, even though there's a cyclical element in it. Yeah, so you need to get the context right. In dividend investing, I think timing is important, right? So how to do it? Of course, we do have a whole process going through it, okay, which I'll not talk about it here. But yeah, timing, I think a lot of time that he got in, unfortunately, is not good. Yeah, that's why even though some of them are pretty decent, he's still sitting on the losses, right? And this is of course excluding the dividends that you have collected. If you include the dividends, I think you have more greens, slightly more greens, the way I see it. Yeah, because I don't know when he bought this, right? Yeah, so there's no context.
Okay.
Yeah.
All right. So, but overall, I think this is a portfolio that is still. I mean, it's not
very bad. I've seen even worse one. This is considered quite good already. For normal retail investor who actually he picks quite a lot of good companies. It's just that the price he paid for those good companies is different. It's not so good.
The last portfolio that we used to manage is like we used to invest in like Epicenter, High Flux.
Oh no,
those are gone, right? So we clear out. The moment we see, we clear out.
Okay.
Right, when we saw it, we clear out.
Okay, so
before they collapse,
if you could give a rating for from A to F, how would you rate this portfolio then?
I will give it a C lah.
A C.
Yeah.
Okay.
I mean, if he can pay at a good price and all this stuff, will go to B or A. And
okay.
Yeah, I put a D lah. Deploy everything at one go, then it should deserve more cash and then
But it's still something that is can
but he never give the cash, so you don't know. Maybe he still got cash.
No, maybe then maybe
he has another 2 million in cash.
Then that one will be B.
He only send. The person only send the broker statement.
Okay.
True.
But he never show us the cash, what?
Yeah. Okay.
Right? Yeah. So maybe he have more cash.
Okay. Yeah. So anyway, we're just sharing our opinion here. We don't have full information.
Yeah.
But based on what we see here, this is our opinions.
Yeah. Again, this is based from his broker statement.
So no recommendation to buy or sell anything. This is not. Please do not treat this as financial advice.
Yeah. It's just a way for us to look at the portfolio, and you can do the same thing for yourself.
Yeah.
Right.
Yeah.
So just a quick way for you to optimize your portfolio. You need to do it.
And it's something you should do once a year. Right?
Yeah, correct. Yeah. I think the person is nice to send us this portfolio, and we also do share so that I think everybody can learn from it. I mean, he agreed to let us share on the YouTube, right? So everybody can learn, so that you also can improve your own portfolio.
Okay. So once again, if you're actually interested in having us rate your portfolio, you can just email your portfolio anonymously to contact@fifthperson.com. That's our email address. Send us your portfolio that you want us to review, and we won't promise that we'll review every portfolio that comes in.
It's impossible.
Yeah, there could be too many, or but we just want to pick portfolios that are pretty interesting to look at based on what your investment goals are, what your risk profile is. Sometimes you get portfolios that are just entirely mismatched from what you actually want to do. Sometimes people don't realize that. So if you're interested in having us rate your portfolio, just feel free to email your portfolio to contact@fifthperson.com. We'll have a look at it. If there's anything interesting that we can share with everyone here and all of us can learn something from this, we'll definitely share it on another roundtable. I think that's a good idea, right?
Important to remember, not a recommendation to buy or sell. Even though we don't like it, it's your decision at the end of the day.
This is not financial advice. Okay, so with that, is there anything else you want to share about this? And when you want to end things off,
I'm sure there are a lot of you who send you the portfolio. Free service, why not?
Okay, so I think that's pretty much it. I hope you guys learned something from this. A lot of companies here, some good, some bad, some a bit ugly. But still, this is a portfolio that I think in the long run could turn out pretty well.
Yes, correct.
Okay.
Yes.
So my name is Adam. That is Rusmin, Victor.
Thank you.
Thank you so much for watching. Any questions, feel free to put them in the comment section. Please hit the like button. That will really help us with the algorithm. And of course, subscribe to our channel. Many more roundtables coming up. And we'll see you again.